And now, finally, the Fed preview. We mentioned the Fed so many times. We mentioned the hike. Here's Janet Yellen hiking. Okay, that's not a real picture, but and Janet Yellen on a US dollar bill. So that's the big event we have been waiting for. Again, markets did move quite a bit. It's not that tension held things back, maybe only in dollar yen. So let's talk about the Fed, a hike, and what's next. A bit of background, wait and see approach. So we had a hawkish hike in December. The Fed upgraded its dot plot from 2 hikes in 2017 to 3 hikes, but markets saw only 2 hikes. Then we had a disappointing wage growth report in January, and we learned that Fed officials actually believed Trump. Actually, they priced in a fiscal stimulus into their projections. And we learned that, well, Trump is moving slowly on infrastructure and taxes. In any case, there was some, disillusionment, some expectation that the Fed will only raise rates in June. But then things changed quite rapidly. So 2 weeks ago, we had a coordinated attack, a chorus, if you wish. Doves and Hawks all talked about a compelling case for raising rates. Rates are too low. Relatively soon is relatively soon. Very strong words, and even Yellen said they will basically raise rates, barring any disaster. The non-farm payrolls was good enough, no disaster. It's very rare to see the Fed talking in one voice. Usually they're all over the place. Doves are dovish, hawks are hawkish, and this one, in this case, they not only talked in one voice, but this voice was a hawkish one. Remember, Fed officials, Yellen and beforehand Bernanke, they usually see the dovish side. They're usually very cautious. Okay, so that was a very, very clear message. So I would say I'm going to present soon 3 scenarios for the Fed. All of them include a rate hike today. There's no chance of a no hike. Okay, the big question for the Fed, big question for the US dollar is the dot plot. Okay, this weird chart shows how many rate hikes are forecast for the next years. 2017, 2018, 2019, it's what's on the agenda. Most importantly, how many hikes will we see in 2017? It currently stands at 3 hikes. That means 1 today and 2 more, maybe in September and December, maybe in June and December. It doesn't really matter at this point. What matters is, will they change the dot plot? And that's the most important event today. We also have the statement, of course, like in every meeting. And we also have forecasts for growth, inflation, and employment, as well as the press conference by Janet Yellen 30 minutes after the event. Another opportunity to invite you all to the live coverage of the event with Valeria Bednarik, Mauricio Carrillo, and myself. So what will determine the Fed's dot plot? What will determine their general tone, more hawkish or more dovish? The Fed always tells us they're data dependent, and the Federal Reserve has 2 mandates, jobs and inflation. So if we look at the Fed mandates, it's a rosy picture. Jobs continue growing nicely, 200,000 or more, around these figures every month. That's solid job growth. Inflation looks stable. 1.7% is the Fed's favorite number, the core PC price index, about double the core inflation in Europe, very close to the 2% target, and rate hikes haven't pushed it down so far. The Fed wants to be ahead of the curve to keep inflation controlled before it gets out of control, okay? And other inflation figures like core CPI and various other measures, they look healthy as well, okay? Not overheating, not and not in deflation territory. So it's a good time to raise rates. However, looking forward to the future, what the job growth and wage growth and inflation gains are a result of growth. There is a lag, and growth looks a bit worrying. So we had strong growth only in the 3rd quarter of 2016. If we look at recent history, 3.5% annualized, but it was around 1.5% in Q1 and Q2 last year, and in Q4 it was only 1.9. Okay. It wasn't a tale of 2 halves, it was a tale of 1 strong quarter and 3 weak ones. If we look at the initial figures for Q1 2017 for this year, We're already 2.5 months into the quarter. We have some figures, retail sales, durable goods orders, other stuff, and we have estimates. So if we look at the Atlanta Fed estimate, the nowcast, it's only 1.3%. Okay, so current growth estimates for Q1 look very weak, very poor, and Trump, which was expected to boost the economy with infrastructure spending and tax cuts, he's focused currently on healthcare, Trump care. Okay, so of course the Fed is in a wait and see approach with the Trump, not so optimistic. So these policies are not pro-growth. So without growth, employment is set to slow down. Okay, so if the Fed looks forward, looks into growth figures and projects them on employment figures in the future, it doesn't look that rosy. So let's talk about the scenarios. My baseline scenario, is what I call a healthy hike. Okay, that means no change to the dot plot. That means the Fed raises rates now because it told us so. It leaves the forecast for 3 hikes, and it tells us it's in a wait and see mode. It means it's data dependent, as they always say, moving along as the economy moves forward. Markets could doubt that there will indeed be a 3rd hike. Maybe they'll begin pricing in, once again, like in December, only 2 hikes. And even if they don't doubt that, we could see a moderate sell the fact response, okay, like we've seen to the NFP, okay? And then perhaps a second wave of selling. Now, in this scenario, it's not such a big change, but we could still see a sell the fact and perhaps, of the dollar, and we could see a moderate fall in the US dollar, nothing too big, okay? They could also be a bit more optimistic without changing the dot plot, and in this case, the dollar would remain stable. This is the baseline scenario, which is in line with what markets are expecting, okay? Now let's move on to the other scenarios, okay? If you probably heard this phrase, if you're tuned into financial analysis, a dovish hike. Can a hike be dovish? I mean, how can you raise rates and be pessimistic, be dovish? Well, one excuse is that the Fed is raising rates in order to be able to lower them if things get worse later on. I don't really buy that argument. Why would you do that? Why would you cause financial distress so you'll have the tools to battle this financial distress? I don't get it. But there's another theory that says stock markets are looking good now. The Fed works for Wall Street, if you wish. It's a good time. They're taking an opportunistic approach, raising rates now, because later they cannot do that, okay? Because later stock markets could be more in a turmoil, okay? So they'll hike now on good financials and then wait for a long time. In this scenario, they will stress that there's, high uncertainty ahead. They'll downgrade the dot plot to 2 hikes this year, or even if they don't downgrade that, they'll be very, very dovish. They'll be very worried, say, okay, we raised rates, but we're going to take a big, big pause. And this could trigger a big dollar sell-off. It could trigger an immediate fall of the US dollar tonight, and then follow-ups in the Asian session and in the European session tomorrow morning. This has lower probability, but I wouldn't rule that out because the Fed is naturally dovish, okay? And I don't think that their talk with one voice about the hawkish, in a hawkish tone about raising rates, I don't think it's the new normal. I think it's the exception, not the norm. So I would give this scenario a sort of medium chance, for a dovish hike, for a dollar sell-off. And scenario number 3, which I see as having very low probability, is a hawkish hike. It means Yellen expresses high confidence. They even hike the dot plot to 4 hikes this year. That means now in March, then in every big meeting, that means June, September, and December. That means they're very optimistic about the US economy. They're foreseeing strong growth ahead. The dollar rallies hard in the immediate reaction and continues higher. Again, I see a low probability for that. The Fed is naturally dovish, but we have to get ready also for this scenario. So to conclude our Fed forecast, Fed preview, it's going to be a rate hike that appears in all my scenarios. The dot plot determines the immediate reaction, okay? So the number of hikes for 2017 is the immediate reaction, but it's also important to see not only the dot plot in case it remains on 3 hikes, but also the general tone of the statement, tone in the press conference, and other forecasts. The baseline scenario is for a healthy hike, probably keeping things balanced, and then a moderate sell the fact scenario could be seen, a weaker US dollar, but it also depends on the tone. Other scenarios are more extreme, a dovish hike that would trigger a big sell-off, and a hawkish hike that would trigger a huge rally in the US dollar. Okay, so that's our Fed preview.